Today is Monday, September 25th, 2 p.m. section 201. This class is being recorded. First and foremost, I'm going to hand out the sign-in sheet. Make sure you sign this sign-in sheet before you leave today. Started on this side of the room, kind of work my way around. I'm also going to do a quick check-in on the Bloomberg Trading Challenge. You are section 201. So here is where we stand as of today. Again, you're being graded on portfolio value. Unfortunately, the markets have been really tough recently. So the leading team at this stage has actually lost the least. So this team, Manival, has only lost 1.17%, and they are currently in the lead. Now, before 3 more weeks are up, they need at least 3 more longs. Everybody has to have at least 10 longs each half of the semester. So otherwise they'd be disqualified. So they still got to invest in 3 more stocks. But everybody else has met that minimum threshold of 10 longs. And remember, you can't be more than $300,000 in cash. So even though the market's been miserable, you still have to keep trading, right? So in this case, it's just a tougher market out there, right? But obviously, even this week, more things are happening. Nike's about to report earnings. I just bought my iPhone for $1,500, got it delivered on Friday, went to an Apple store on Saturday to buy a case. Place was a freaking zoo, right? And I only say that because that's kind of good for Apple. The fact that there were, 40 people in line waiting to buy phones on Saturday, they might have actually exceeded expectations for the iPhone 15. That could actually help their stock price in the short term if that proves to be true. Yes, sir.
Just a question on, can you keep $300,000 in cash throughout the semester as long as you make 10 trades?
You can never have more than 300,000 regardless of the trading. It's an equity competition. So you sell something, buy something else. Can't stay in cash. I think in this market you might be like, gee, I'd rather hoard cash, but that's not the point of the trading sum. Yes?
I have a question for the homework, for the group project. Do you want us to use operating ROIC or just normal ROIC?
Operating ROIC, now that we have it. Okay. All right, so let's talk about last week. We had 2 homework assignments we're due today, homework 4, homework 5. Homework 4 was the conversion. In the folder, files folder on Elms under homework 4, I'm just gonna post the solution today. So you can kind of check the solution against what you converted. If anybody has any questions, feel free to ask them. But I think if you kind of see, what the solution was and what you did, you can figure out any challenges you had. Remember, TA's office have hours this week, Thursday or Friday, if you're really struggling with the concept. But today I want to spend more of our time in the second half of lecture note 2, preparing you for homework 6 and 7. And so I'm not going to cover the conversion again unless somebody has a very specific question. Okay. For homework 5, what you should have done is the first part of homework 5 is you should have created the operating ROIC formula. Anybody have trouble creating the operating ROIC formula? Okay. Assuming you did that and used the equity screening tool, op ROIC greater than 20%, 15% year-over-year growth, and bill beta of 2, you should have come up with a list of 10 companies that met that criteria. You basically submit the screenshot, which here's an example of the screenshot with the 10 companies that, where was it, where'd it go? With the 10 companies that meet that criteria. I guess I thought I'd had the screenshot not handy. All right, any trouble with the equity screening tool? And then the other part of this is you should have done the Microsoft spread using operating ROIC. You'd have gotten an operating ROIC for Microsoft of 44.88% against a WACC of 10.98%. Okay. Now I just left the Bloomberg ROIC on here as a reference. You didn't need that, but that would be the point. Like Microsoft's average ROIC is kind of like Apple. They got a lot of cash, right? So Microsoft is an operating ROIC of about 45%. A much lower return on their cash averages out to be 28% a year. Right. You'll also notice there were a bunch of blanks for operating ROIC. Even though we put the formula in, sometimes Bloomberg has trouble calculating it in real time for some of these companies. All right. So it doesn't mean they don't have one. It just means Bloomberg with a dash says it's having trouble calculating it. right? But nonetheless, this would have been the screenshot that you would have turned in as the other part of homework 5. All right, so any questions about homework 4 or 5? I know we went through that relatively quickly. All right, 1 week from today, you will be doing your first group case presentation on EIC, okay? That will be a 10-minute PowerPoint presentation your team will make on Siemens Energy. And the fact that Siemens Energy is a German company is irrelevant. Same concept for E, the I, and the C for Siemens Energy. The only difference is that when you do Siemens Energy, remember that Siemens, oh, here's the 10 companies, by the way, on this list. Let's turn on the screenshot. When you do Siemens Energy, they have 3 segments, okay? So essentially, you're going to be doing at least 6 screenshots. You're going to be doing the E screenshot with the betas, RV markets betas, for each of those 3 segments, 3 screenshots, and you'll have 3 RVs for each of their 3 segments for the operate spreads. Just FYI, Siemens Energy was a spin-off of global giant Siemens. It's now publicly traded, okay? So it's their energy business, but it's now an independent company. It's not part of Siemens anymore, right? But nonetheless, when you go through Siemens Energy, make sure that under RV, which I told you to do in the assignment, you're not doing the whole firm, you're doing it on these 3 businesses. So practically, what does that mean? That means in 10 minutes, you're going to have to go through all 3 businesses, all 3 E's, all 3 5 forces for today, all 3 5 forces for 5 years, and the competitive advantage for today in 5 years. Right? That's a lot to cover in 10 minutes. Right? So basically, first thing is your PowerPoint presentation needs to be submitted 10 a.m. Monday before the start of classes. And everything you're going to present has to be in that PowerPoint. If it's not in that PowerPoint when you're presenting it, I'm not giving you credit for it, no matter what you say. So all the data has to be in that PowerPoint presentation for all 3 of those segments. That's your presentation. That's just fairness to all the groups that are doing. We got to go through 6 teams that day in every section, which means that's an hour. Okay? So I have to hold everybody to 10 minutes, if nothing else, out of fairness, but to make sure we get through them all. So at the end of 10 minutes, I'm cutting you off. I might give you like 10 seconds to wrap up, but 10 minutes means 10 minutes. If you don't get through everything in 10 minutes, it won't be graded. Okay? Now, I'm just warning you based on past semesters, this is a lot of work to do in a short period of time. So I would not make next Monday the first time your team is doing this live. Like, practice, right? And if you need to use note cards, it's perfectly fine to make sure that you capture everything in there. Like in this class, I don't grade you on how you're dressed. So come as slovenly as you want, I don't care. But what you say is all of your grade, okay? Make sure you cover everything and make sure that you're using numbers throughout the presentation. Don't just start talking general terms, you'll lose points for that as well. Okay. Again, you've done a few EIC assignments. Questions about your group project next Monday? All right, one other word of warning. The I part of this can go really long, the 5 forces. And I'm not saying that 5 forces isn't a lot to cover, but remember you got to do 5 forces by 3 segments, today and 5 future. If that runs like 7 minutes, that means you got 3 minutes to do the entire rest of the presentation. All right, so that's why I go back to practice. All right, if you really think about it, you won't have 7 minutes to do the 5 forces. You'll have to do it much more efficiently. Okay. So again, when you split up the work together as a team, figure out who's going to present. All 8 people on your team don't have to present. Okay. Whoever's going to present can present on behalf of the team. That could be 1 person. That could be 3 people. But I'm just telling you, they should practice and make sure they can deliver it all in 10 minutes and come prepared. Right. Because if you put it together at the last minute, the night before, everybody's got their section. Everybody just presents for the very first time live. It's likely not to go well, okay, just based on past experience, right? Now, the other thing about grading, remember, is that is worth 10 points to your semester grade. Everybody gets a group grade. However, I am grading 8 out of the 10 points that day, okay? The other 2 points will be one of the other teams in this room who will grade you. Okay, and I'll post this later in the week, but basically team 1 will be graded by team 2 will be graded by team 3, etc. Those grades come in Tuesday. So you have basically one day to grade your peers and submit that grade. And I'll put a link up to submit that grade by Tuesday, end of day. Okay, that'll be the other 2 points of the presentation. By Thursday of that week, you're also going to do your peer reviews. Everybody gets the group grade by default, but if you didn't fully participate, you shouldn't get the group grade. So you want to peer review all the members of your team and talk about their level of participation in the group project from a 0 to 100% scale. Even if you're not doing the presentation, you should still be there to help create that presentation. And you got to be here physically in the class as we talk through that presentation. Okay? So that's why the peer reviews are another important part of the process for this grade. Any questions about the group project next Monday? All right, so as I said, in just a minute, we're going to go through lecture note 2. That's going to be the material for homeworks 6 and 7. All right. Unfortunately, for me, on Wednesday of this week, I am having surgery under general anesthesia. So we will not be having a live class this Wednesday. Okay. But what I'm going to do is I'm going to post the next 2 homework assignments. Homework 6 due Monday. Homework 7 due the following Monday. And you might want to get a head start on homework 7 this week. So you're going to have class time this week to do that. And you also have class time this week to work in your team projects to prep for next Monday, right? But there'll be no live class. The next time I'll see you is 1 week from today. Okay, and I'll be sitting right there for the presentations, listening for a grade, and minding the clock of 10 minutes per team. Okay, now I say that because, just as a preview, homework 6, relatively straightforward. Homework 7 is going to be more difficult for you. So you might want to start this week on homework 7, because for homework 6, I'm going to give you ROIC drivers today. I'm going to give you the CFI drivers today, and we're going to talk about how we analyze historical statements today. Okay? But I'm going to give you the statements to analyze. For homework 7, I'm not going to give you the statements. I'm going to tell you the real world company. You're going to take their real world income statements and balance sheets and create these ROIC trees and create the CFIs, which you will then analyze. Okay? Because what I found over time is that if I just give you the answer, it's easy and you don't have any idea where the data came from. If you put these things together yourself, you have a better idea of where it came from. So I'm going to ask you to put them together as part of homework 7. That will be a more ambitious assignment. These are both individual assignments over the next couple weeks. So a lot coming up here over time. Saw a hand over there. Question?
Yeah, I was gonna ask, how our midterm is structured?
So the midterm exam is coming up. You will take it during class time, but you won't have to be here physically. It will be a 10-question multiple choice exam covering all of the content up to through the midterm date. Anything in the book, anything in the lecture notes, anything talked about in class, all that theory will be the midterm exam. Okay? And basically, there'll be 10 questions on the midterm, 1 point each, 10 points. You'll have an hour and a half to do it during the class time that you're registered for. It's open book, open notes, but I'm telling you, if you didn't read the book and you didn't really pay attention to class, doesn't matter if it's open book, open notes, you're going to struggle with those questions. Okay? Because every multiple choice question will have none of the above as an answer. Okay? And I've essentially made the questions so that they're not that obvious in terms of what the question may be. So a question might be, which of the following would improve the ROIC of a company? An increase in accounts payable, a decrease in inventory, a decrease in property, plant, and equipment, an increase in SG&A spending, none of the above. Okay, those are the types of questions you're going to get on the midterm. So do you actually understand the theory behind the math that you are doing? Okay, I didn't know if the questions I threw out was actually a reasonable question. I just literally made it up on the spot, but that would be the point. Okay, and so I'm going to test you on, have you been paying attention? Do you understand what's going on? But you'll take it during class time, the day of that midterm. Okay, questions? Other questions? All right, so let's talk about lecture note 2. So what we did in our last homework assignment, last lecture note, is we converted the statements to economic format. Today, I want to talk about how we analyze those statements. Okay? So the first one we're going to start to analyze is the drivers of ROIC. And to do so, we're going to analyze what are called ROIC trees, which we'll get to in just a second. But what I want you to understand is that ROIC and the first level drivers is based on algebra. And the algebra is this. Margin is profit divided by sales or revenue. And what it answers the question is when we sell something, how much do we make? Okay, that's just margin, right? EBIT margin, operating margin. Okay, but ROIC is different. It's profit, same profit, divided by invested capital. So what ROIC says is how much did I have to spend to make the profit? Different denominator. That's ROIC. So the question is, how do I connect the two? Well, here's where algebra comes in. If I multiply P over S by blank over blank, I can get equals P over IC. So the question is, what is the blank over blank? P over S times blank over blank equals P over IC. What does the blank over blank have to be? It's like 8th grade algebra here. Yeah. Yeah, sales over invested capital. So S over IC. Now, writing it this way is important because what it tells me is there are two drivers, and this multiplication sign right here tells me that they have equal weight in determining ROIC. There are two things that have equal weight. The first one is P over S, how much we make when we sell something. And the other thing that matters is the S over IC. The S over IC basically says, how much do I have to spend to generate sales? That's called productivity or efficiency. And those are the two drivers of ROIC that explain ROIC. Now, in the tree that I give you with this algebraic equation, I'm going to actually represent the tree as IC, the reciprocal. Sorry, drawing my mouse is tough. IC divided by S. So in the actual tree, it's the reciprocal. So P over S times 1 over IC over S equals P over IC. Okay? But the idea is these two things have equal weight. And these are called the first level drivers of ROIC. There are three, there are always three, and you always have to talk about all three. Why did ROIC change? One driver, tax rate. We look at the impact of taxes because taxes have to be paid before the investors are paid. When we take out the impact of taxes, we're left with a pre-tax ROIC. What are the drivers of pre-tax ROIC? Margin, productivity. Those three drivers, margin, productivity, tax rate, explain anybody's ROIC. Clicking down, what drives profit? That's the income statement. That's called the second level drivers. What are the three items in the income statement that determine profit? Gross margin, SG&A, depreciation as a percentage of sales. That equals EBIT, and therefore EBIT margin. So how did those three things change to explain any changes in profitability? Clicking down to the balance sheet, invested capital is working capital plus PP&E plus goodwill and intangibles. That's operating invested capital. How did those three drivers change and explain what's happening with company's productivity? So that's the ROIC tree we are about to go through. I'm going to start with a working example of Starbucks. Okay? And this is an ROIC tree. It's a 5-year historical look back at Starbucks ROIC. And it's the EOY ROIC. EOY stands for end of year. And when you did your homework assignment, you did BOY. You did beginning of year. Okay? End of year means current year no plat divided by current year invested capital. Okay? And it's a 5-year change. For homework 6, I'm going to focus on year 1 and year 5 and the 5-year change. And you're going to have to explain why it changed over 5 years using these drivers. However, after you get through homework 6, you're also going to have to worry about, as an and, the intervening years. Okay, so for the first assignment, beginning and end, we're going to kind of skip the middle. But in future assignments, you got to care about the middle as well. All right? But while you're learning the statements, I'm simplifying homework 6. So here's how we can think about Starbucks. In 2017, Starbucks ROIC right here was 48.3%. And 5 years later, it fell to 23.2%. That was a 5-year 51.9% decline. All right, so over a 5-year period, their ROIC fell from 48 to 23%. Why? There are 3 potential reasons for that. 1 is the tax rate. 2 is the operating margin. 3 is the productivity of the invested capital per sales. Those are the top level drivers. Those 3 things mathematically explain a change in ROIC. Okay, let's start out by looking at the impact of tax rate. In 2017, Starbucks paid 33.2% in taxes. In 2021, their tax rate paid fell to 21.6%. Is that favorable or unfavorable to ROIC? If your tax rate goes from 33% to 22%, does that help or hurt your ROIC? Yes, that helps. So if I'm trying to explain why ROIC fell from 48 to 23, it's not because they're paying more in taxes. They're actually paying less in taxes, which should be favorable to the ROIC. But I still have to talk about it. So when we strip out the impact of taxes, we're left up here with the pre-tax ROIC. The pre-tax ROIC went from 72.3% to 29.6%. Okay, so the returns selling coffee and other products went down dramatically over the 5 years. Now we talk about drivers 2 and 3. Operating margin. How much profit per dollar of sales are they making on their products? In 2017, they're making 18.5 cents a profit per dollar of sales. In 2021, they're making 16.8 cents of profit per dollar of sales. Was that favorable or unfavorable to the pre-tax ROIC? Yeah. It's unfavorable. They're clearly making less money on every product that they sell. That's going to lower the pre-tax ROIC. Driver number 3, productivity. Here's how to read this. In 2017, so this is going to be unfavorable. Invested capital to sales. 2017, to drive $1 of sales, they spent 25.5 cents on invested capital. That's their productivity in 2017. In 2021, to drive the same dollar of sales, they spent 56.6 cents on invested capital. Is that favorable or unfavorable to the ROIC? If the amount you spent to drive sales goes up by 121%, is that favorable or unfavorable to your ROIC? It's unfavorable. So 2 of the 3 drivers, how much they make when they sell a product and how much they're spending to sell that product, are driving their pre-tax ROIC lower. They're spending more and they're making less. That's what we see happening over the 5 years. Does everybody see that? That's the first level drivers. Now, the most important of the first level drivers is that the invested capital to sales going up and more than doubling probably had the biggest impact. That was driver number 1 that hurt their pre-tax ROIC. The margin going down also hurt them, but probably not as much because the margin went down by 9%. These 2 things equal each other in the multiplication. And the invested capital to sales more than doubled. So it was really the worsening of productivity had the biggest impact, but the margin also hurt them. It was slightly offset by the lower taxes they paid, but that's why their pre-tax ROIC went from 72.3 to 29.6, and their overall ROIC went from 48.3 to 23.2. That is what's called your first level analysis. That's what you got to do. You have to use numbers. You have to talk about the impact of the ROIC. and basically explain the changes over time. Questions? Then we do the second level analysis. You're clicking down. Start with operating margin. There are three things on the income statement that lead to your operating or EBIT margin. Gross margin minus SG&A minus depreciation equals operating margin. These three things explain operating margin. Okay, so why did the operating margin go from 18.5 to 16.8? First, the gross margin on their products, price minus cost of goods sold as a percentage of sales, went from 35.3 to 34.1. They are making 1.2 cents per dollar less on gross margin. Is that favorable or unfavorable to the operating margin? It's pretty unfavorable. Okay, you're making less profit. SG&A went from 13.8 cents per dollar of spending to 13.4 cents per dollar of spending. They actually spent 0.004 cents less in SG&A. Now that's pretty flat. So I would say it is slightly favorable, but not dramatic to really impact things. The third driver is depreciation as a percentage of sales. In 2017, they were spending 4.8 cents of depreciation per dollar of sales. 2021, 5.2 cents. Okay, that went up by about 4 cents, 0.004 cents. Okay, so they went from 5 cents to 5.2 cents. Slightly unfavorable to your profit margin, but if I look at the three drivers, the one that had the biggest driver of the operating margin going down was the gross margin falling from 35.3 to 34.1. That was the primary reason the operating margin fell. They're making less on the markup of their products. Click down number 2. Why is the productivity worse? Why are they now spending 56.6 cents per dollar to drive sales when 5 years ago they were spending 25.5 cents? Again, these three things drive invested capital. It's OpWC, which is operating working capital, plus the PP&E, the property, plant, and equipment, plus spending on goodwill and tangibles. You add those three things together and you get invested capital equals. So add those three things in the bottom right and you get invested capital to sales. So there's three drivers of spending on invested capital, right? Let's start out with working capital. In 2017, they had negative 5 cents of working capital. What does it mean to have negative working capital? How does that occur? OpWC is working capital, operating working capital. How do you have negative working capital? Generically. Yeah.
You have more current liabilities than current assets.
They have more current liabilities than current assets. Now, financially, if you have negative working capital, does that kind of help or hurt your invested capital? It actually helps. Because if I have negative working capital, I don't have to borrow as much invested capital. So it actually is favorable to the IC. Now, it also means I might need to go borrow cash because I don't have cash coming in the next year. But as long as I have access to liquidity, lower working capital is better. Okay? Now, they went from negative 5 cents of working capital in 2017 to negative 7.5 cents of working capital in 2021. Is that favorable or unfavorable to invested capital? Negative 5 cents to negative 7.5 cents of working capital. That's more favorable. They basically have 2.5 cents per dollar more liabilities relative to assets of working capital. So they have less invested capital because of that. The next item on the balance sheet is property, plant, and equipment, PP&E. This is spending on the stores and the equipment inside. So basically in 2017, they spent 22 cents per dollar of revenue on PP&E. In 2021, they're spending 50 cents per dollar on PP&E. Is that favorable or unfavorable to ROIC? That's very unfavorable. They're doubling their spending to generate sales. The third driver is intangibles. This is spending on goodwill, purchase price premiums. In 2017, they spent about 8.8 cents per dollar on intangibles. In 2021, they spent 13.9 cents per dollar in intangibles. Is that favorable or unfavorable? That's unfavorable. Okay? So why did their productivity worsen? Well, one is they spent more on intangibles, but the real reason is they spent a heck of a lot more money opening stores relative to their sales. Spent a lot of money in PP&E. That drove their invested capital to sales lower. Does everybody see those dots being connected? You following? Yes.
Could you explain why it's have a negative operating working capital?
Well, what I'm saying is generically, you want to have lower working capital. Generically, you want to have lower working capital. Generically, you want to have less PP&E. And generically, you want to have less intangibles, all to drive sales. I don't want to spend any money to drive sales. I want to have more ROIC, less invested capital, more sales and profits, okay, generically. So lower working capital means less invested capital, okay? So as long as you can get away with it without screwing your suppliers to the fact that they won't work with you anymore, they start charging you more, if you can have negative working capital, that's favorable to the equation, okay? So generically, lower working capital helps your ROIC. That's what happened with Starbucks here. They went from negative 5 cents to negative 7.5 cents. They basically have their suppliers funding more and more of their business. That is favorable to not having as much invested capital in the business. But that offset the fact that they spent 50 cents per dollar on stores where they were only spending 22 cents per dollar to open the stores relative to sales. Spent a heck of a lot more money on their stores, and they did an acquisition. Now here's an example of beyond homework 6. Looking at the goodwill and intangibles line, bottom right, what year did they make the acquisition? Can we tell? What year did Starbucks make a big acquisition? Yeah. It's 2018, because that was the big jump in intangibles. So here's the point. In a future assignment, you'd point that out, and in a future assignment, you'd have told me who they bought. Because it's pretty clear they bought somebody who they buy. Okay, why did it drive the intangibles up? I'm not asking for that in homework 6, but starting in homework 7 and future projects, I am. All right, questions about any of this? Once you cover the first level drivers, once you cover all of the second level drivers, means always tax rate, operating margin, invested capital to sales. Always, what drives operating margin, what's going on with gross margin, what's going on with SG&A, what's going on with depreciation. Always, what's happening to invested capital sales, what's happening to working capital, PP&E, and intangibles. You have to cover every item. You have to talk about the change using numbers and whether it was favorable or unfavorable to the item above and ultimately to the ROIC. Yes?
So essentially, intangibles is the one that the company makes an acquisition.
It's the purchase price premium. It's how much do you pay above the assets for what you bought. Price minus assets purchased equals goodwill. So intangibles go up when you buy somebody else's company, buy their intangibles. Other questions? All right, once you've gone through all the drivers from left to right, you'll summarize right to left. So here's the summary. Starbucks, which spent a lot more money on PP&E to sales, driving it from 22 to 50, and earned slightly lower margins on their products as their gross margin went from 35 to 34.1, led to a pre-tax ROIC dropping from 72.3 to 29.6, which was also helped slightly by a tax rate which went from 33 to 22, which helped a little bit, but it still was not enough to offset their ROIC after tax falling from 48.3 to 23.2. That is what you have to write up using numbers for your next assignment. Let's practice this again on company number 2. Company number 2, Target. Okay? So, what happened for this 5-year period with Target? In 2017, their ROIC after tax was 13.5%. By 2021, it had improved to 20.5%. That was a 52% 5-year improvement. Why? Reason number 1, taxes. Taxes went from 32.7% in 2017 to 21.2% in 2021. Did that help or hurt the overall ROIC? Was that favorable or unfavorable? Going from 33% taxes to 21% taxes. That helped. So one of the reasons why Target's ROIC went up after tax is because they paid less in taxes. That helped them. Clearly helped them. Now, taking out the impact of taxes, what happened to their pre-tax ROIC and their underlying business? That went from 20% to 26%. So the pre-tax ROIC also improved. Why? Driver 2, margin. In 2017, they made 7.2 cents of margin when they sold a product to you, pre-tax. In 2021, they made 7 cents of pre-tax margin. Is that better or worse? Slightly worse. They're making slightly less every time they sell a product. Well, that's not helping their pre-tax ROIC. Okay? You're talking about flat to slightly worse. So why did the pre-tax ROIC go up? It's all invested capital to sales. In 2017, they were spending 35.7 cents per dollar of invested capital to generate sales. In 2021, they're spending 26.8 cents per dollar of sales on invested capital. They are spending less to generate sales. Okay? That's the whole reason why the pre-tax ROIC went up. It wasn't margin. It was actually productivity. That's your first level analysis. Questions? Yes.
When we're doing our first level analysis, should we like talk about like both things, like one of them didn't help?
I want you to, for each of the ones, helped or hurt. That's why I keep repeating myself. And then I want you to start thinking about magnitude. Like if both helped, did one help more than the other? Okay? Because that's the point. You're basically explaining what's happening to the ROIC by going through these three drivers mathematically. That's the first part of the assignment. That's the connecting of the dots I need you to be able to do. Okay? Then we're going to do the same thing with the second level drivers, but I break them out separately. So what drove the operating margin from 7.2 to 7? That's not a meaningful change, but did anything happen in the underlying income statement? Well, their gross margin went from 32.6 to 31.9. That's 0.007 down. Okay? That hurt. Their SG&A went from 22.1 to 22.3. That's 0.002 worsening. That slightly hurt them. So slightly lower gross margin and a slightly worse SG&A as a percentage of sales. And then depreciation went from 3.3 cents to 2.7 cents, which was favorable. So that's the point. They had favorable spending on depreciation, which kind of offset the SG&A improvement. And really, the real reason the operating margin got a little worse was because the gross margin declined. That was the number one reason over 5 years. They're making less markup on their merchandise. Maybe inflation was higher relative to their prices. Maybe they cut prices relative to their costs, but the gross margin went down. What happened on the productivity side? Why are they spending less money to generate sales? Well, their working capital went from essentially zero in 2017 to negative 5 cents in 2021. So they added a bunch of current liabilities relative to their inventory and receivables. That was favorable to their invested capital by about 5 cents. Their PP&E to sales went from 35.5 to 31.1. They saved 4.4 cents per dollar on store productivity. They got more efficient with their stores. You were buying more out of the same stores. And those two together, 4 cents of PP&E and 5 cents of working capital, that was the improvement in invested capital to sales. Right? And intangibles went from basically 0 to 0. They don't really do a lot of acquisitions. So goodwill was not meaningful to Target. All that improvement was working capital number one, and right behind it, 1A, was PP&E improvements on their stores. And that was the primary driver of the invested capital to sales getting better, which was the primary driver of the pre-tax ROIC getting better, which was the primary driver of the after-tax ROIC getting better. Summarize right to left after you go left to right. Again, questions? Let's do one more. Here is Dollar General. Same 5 years. I'm going to give you a few minutes to look at this before we go through it. See if you can piece together how this tree connects first and second level for Dollar General over the 5 years. So looking at the data, see if you can explain it to yourself. Because this is your homework assignment. This is homework 6, half of it. Except it won't be on Dollar General. All right, does anybody want to try and practice on this? All right, well, if you were trying to practice, you would start out with the end of year ROIC, which went from 16 to 11.6, and you'd have to explain a 27.8% 5-year drop in Dollar General's ROIC. All right, and so the first thing you would have looked at was the tax rate. The tax rate went from 19.3 to 21.7, 12% increase in taxes paid over 5 years. Is that helping or hurting the ROIC? It's hurting, so that's unfavorable. So that's one of the reasons why the ROIC went down. They're paying more in taxes. That's slight. But the underlying business, the pre-tax ROIC was even worse. It went from 19.8 to 14.8. So really the primary reason was something the underlying business got worse, but they did pay a little bit more in taxes. Now, why did the pre-tax ROIC got worse? Starting out with operating margin, they were making 8.6 cents per dollar when they sold a product to you in 2017. They made 9.4 cents per dollar of profit in 2021. Is that more favorable or unfavorable? That's more favorable. That should be helping their ROIC. So the fact that their profit margin went up, that's not why the ROIC went down in the operating ROIC. It's all productivity. In 2017, they were spending 43.1 cents per dollar on invested capital. By 2021, they were spending 63.8 cents. Right? That's almost a 50% increase in invested capital per dollar of sales. That's why the operating ROIC went down, and it more than offset the slight rise in their margin. So, giant increase in invested capital sales, slight increase in taxes, drove down the end of year ROIC from 16 to 11.6. Those are your first level drivers. Is everybody following all that so far? Second level drivers. Why'd the margin go from 8.6 to 9.4? Well, their gross margin went from 32.5 to 33.5, which suggests that their price minus cost went up. They're getting better markup on their merchandise. Okay? Their SG&A spending stayed flat, 22.2 to 22.2. So I'm getting better markup on my merchandise, better gross margin, same SG&A. Depreciation went from 1.7 to 1.9, slightly unfavorable, but it was really the gross margin going up by about 1% that led to the improvement in operating margin going from 8.6 to 9.4. Everybody follow? Okay. On the balance sheet, why'd the invested capital sales get worse? Why'd it go from spending 43 cents per dollar to 64 cents per dollar? Well, their working capital went from 8 cents to 5 cents. So like Target and Starbucks before them, they knocked 3 cents out of working capital. That's favorable to your invested capital. Okay? PP&E to sales went from 11.5 cents to 42.2 cents. They quadrupled their spending on stores relative to sales. And intangibles, they went from 23.6 to 16.2. So they didn't really buy anybody new. They got some efficiency on their intangibles. Okay? They got some efficiency on their working capital. All of the worsening of the productivity, the invested capital sales, was because the PP&E to sales quadrupled from 11.5 to 42.2 cents. So summarizing, it was that reduction in PP&E productivity, 11.5 to 42, which was the primary reason why the invested capital sales went from 43 to 64, which was the primary reason why the pre-tax ROIC went from 19.8 to 14.8, which was the primary reason why the after-tax ROIC went from 16 to 11.6. Over this 5-year period, Dollar General was on a massive expansion of their stores nationwide. They got a little bit more margin on their stores, but they spent so much to open the stores relative to the sales they got that it hurt their productivity short term. That's what we see in their ROIC tree. Questions? Yes, sir.
So the interpretation for PP would be like opening stores and like actual like locations and then
Well, the interpretation would be, this is why I say go beyond just the numbers. Like read the BICO, do the EIC, figure out what the heck's going on with the company. And we've done Dollar General in this class before, and basically Dollar General has been on a massive expansion bid. They're opening up a whole lot more stores.
that include intangibles other than like mergers and things like
But that's the point. The intangibles are going down. So they're not opening stores by buying other stores and converting them to Dollar Generals. They're literally organically opening up new Dollar General stores around the country. And so that's why that PP&E to sales is going up so dramatically, because they're just in a national expansion. Now they think they're making good margins on the stores. Their margins are up. But short term, they're not getting the sales on every store, same store sales immediately, while they're just opening up more and more Dollar General stores. So that payoff's probably going to come later. That's contextually what's going on. Okay? But for this assignment, I just want you to at least connect the dots. If you go further than the dots, great, but at least connect the dots. Higher PP&E to sales, lower, made my invested capital sales go up, which made my ROIC go down. That's the dots I need you to at least start to connect. Questions? Other questions? Statement number 2, CFI. This was the other statement, you convert it. As we talked about, CFI has 4 sections: operating cash flow, non-operating cash flow, debt cash flow, equity cash flow, right? When we analyze the CFI, we always start with the operating free cash flow. And that number is telling to how you do the analysis. If you have free cash flow, the rest of your analysis, what'd they do with the money? If the free cash flow is negative, where'd they finance that? Where did it come from to afford that negative cash flow? Okay, so we start with free cash flow, and that leads to how we analyze the rest of the statement, but we cover all 4 sections. Explaining CFI, how we got to the CFI, free cash flow, non-operating cash flow, and then how we distributed the CFI, where'd it go, debt and equity cash flow. That is basically the structure of the statement, right? Now, for Starbucks, first example here, this is 5 years of historical CFI. Try to make it a little bit bigger. All right. Unfortunately, I can't go full screen because I'm recording, and if I go full screen and record and stop going full screen, it like kills the recording. So, in case you're wondering why I didn't go to full screen mode, that's why. But that being said, there's 5 years of CFI, and then there's a 6th column called the total, which just sums up the 5 years. Okay? For your first assignment, you can focus on the total. What happened over 5 years? For subsequent assignments, you also care about what happened each year. Okay? So just like the ROIC tree, we're starting with beginning and end. Later, you're going to worry about the middle. With the CFI, we're going to start with the sum of the 5. Later, you're going to worry about all 5. Okay? And later as in 2 weeks from now. All right. So the first thing you start with for Starbucks is free cash flow, $3,235.8 million. That is their free cash flow right here. Okay? So if you have positive free cash flow, why? Starbucks generated $20,990 million of gross cash flow from their income statement. They reinvested $15.963 billion into their balance sheet, giving them a 76% reinvestment rate, which means a 24% theoretical payout rate. Okay. Now, Starbucks also spent, giving them $5 billion of operating free cash flow, $1.8 billion on premiums, purchase price premiums, goodwill and intangibles, leaving them with overall free cash flow of $3.2 billion to pay out. The final number on here that I want you to address is this ratio called CapEx to depreciation. All right? Here's an assumption that we make. Depreciation is wear and tear of an asset over time. Okay? We often use straight line. So asset has a 10-year life, it loses 1/10 of its value each year for 10 years. Simplified assumption. If I'm losing 10% of the value of an asset every year, I need to spend 10% of the value of the asset to maintain it. Because if I don't spend my depreciation, it's going to start falling apart. So basically, to maintain the current assets, we make an assumption that companies have to reinvest depreciation. Okay? If you don't reinvest your depreciation, those assets are going to start to crumble. Right? If you invest more than depreciation, that means you're building capacity with probably the intent to grow. Okay? So the 5-year ratio of CapEx to depreciation for Starbucks was 247%. They are spending 2.5 times depreciation on CapEx. What does that generically signal about growth? Do they expect to grow? They expect a lot of growth. Because I'm spending 2.5 times every dollar depreciation on CapEx, I'm expecting a lot of sales. Right? By the way, the big spending was on 2020 when they spent 600% of CapEx to depreciation, which 2021 going into COVID fell to 115%. Right? When I'm getting close to 100%, that means I'm not expecting a lot of growth in 2022. Okay? So over 5 years, Starbucks expanded, but in 2022, they were kind of signaling that, hey, COVID's here. I might slow down my 2022 expansion because that ratio fell to 115%, much closer to CapEx depreciation. So that's another thing, which is sitting here in this statement, is a short-term signaling of what the company thinks about growth. Now, we got $3.2 billion of positive free cash flow. How did that turn into $8.5 billion of CFI to pay out? That means they generated approximately $5 billion of non-operating cash flow. How did they do that? Okay. Well, they made $3 billion, $3.158 billion of non-operating gains over the 5 years. They generated $6.3 billion by selling off non-operating assets. 3.2 and 6.3 is about, rounding off, almost 9. They then took $4.2 billion and they stuck in the bank and increased their excess cash because they put it in a savings account. 9 minus 4 is the $5 billion in non-operating cash flow that led to the $8.5 billion of CFI to be able to be paid out. How did they distribute the $8.5 billion to the debt and the equity holders? Let's start with the debt. They paid out $1.176 billion of interest expense over the 5 years. So that's where $1.7 billion of the $8.5 billion went. Starbucks borrowed $20 billion of new debt over the 5 years. Now, separately, did they need to borrow all of that debt? Did Starbucks operationally need that debt? Yes or no, and there is a right answer to this question. This would be an example of a midterm exam question. Did Starbucks need to borrow $20 billion worth of debt? Yes or no, and why? How do you know? Did they need to borrow $20 billion worth of debt? Yes.
No, because they had a positive free cash flow.
Yeah, they had a positive free cash flow. From operations, they generated $3.2 billion more cash than they reinvested. Well, you don't need to finance that. If you generate more cash than you spend. So why did they borrow $20 billion? Hold that thought for a second. Okay, it wasn't to finance their business. Continuing on, shareholders. Starbucks spent almost $9 billion on dividends, 89.97.6 over the 5 years. Starbucks repurchased $21.5 billion of common stock. What's $21.5 billion plus $9 billion? That's about $30 billion worth of cash to pay to the shareholders. How do you pay your shareholders $30 billion worth of cash if you only have $8.5 billion to pay out? That's the $20 billion worth of debt. They borrowed $20 billion worth of debt so that they could buy back the stock. It's clear. They didn't borrow the $20 billion worth of debt to finance an acquisition. They didn't do any big acquisitions that were that big. They didn't use it to finance CapEx. It wasn't reinvestment because they made more cash than they were reinvesting. They financed all that debt to buy back stock. So here's what I'm saying. I like cash if I'm an investor. Okay? Cash is better than no cash. However, is that sustainable? Can Starbucks, if they repeat the next 5 years, can they keep buying back $20 billion more stock? Well, in order to do that, they'd have to borrow $20 billion more from the banks. That's probably not going to happen. So that's the point. Like, they're buying back the stock, not because their business is doing better. They're buying back the stock because they borrowed the money to do it. And I'm not saying I don't like cash, but if I start to think about the underlying business, that's not a sustainable way to keep paying back your shareholders. And a lot of companies did this because we had all-time low interest rates. Okay? Treasury yields were 1.5%. So why not take advantage of cheap debt and use it to help your stock price? That's what a lot of companies did. That's what Starbucks did. But that's how they did it. They didn't help their stock price because they made more money selling coffee. Right? They bought back all the stock because they borrowed it from the bank to repurchase the shares. And you can clearly see that in the CFI. Remember with me? Let's look at Target's CFI. Same concept. We have 5 years of CFI, the total column, starting out with free cash flow. Target's 5-year free cash flow right here, $18,916 million. Okay? How did they do that? They had $31 billion of gross cash flow. They had $11.8 billion of gross investment. That's a 38% reinvestment rate, which means a theoretical payout rate of 62%, much higher than Starbucks, by the way. They spent $390 million on goodwill premiums, which is pretty trivial for the company their size, so not much in the way of acquisition activity. All of it happened in 2018, by the way. That took $19.3 billion of free cash flow before goodwill down to $18.9 billion after goodwill. That was their free cash flow. Their 5-year rate of CapEx depreciation, 132%, but unlike Starbucks, it was pretty steady every year for 5 years, although it did come down slightly in 2021 to 124%. They're signaling they expect growth, but not dramatic growth, based on the CapEx to depreciation ratio in 2022. Now, what do they do with their non-operating cash flows? $18.9 billion of free cash flow became $15 billion of CFI, which means they spent $4 billion on non-operating cash flow. Clearly, it was the increase in excess cash. So of the $18.9 billion, they took $4 billion of it and they put it in the bank. That left about $15.1 billion to give to the debt and the equity holders. How did they pay out the $15 billion? $2.7 billion in interest. They borrowed $2.3 billion of new debt. They paid out $6.7 billion in dividends, $9.2 billion of share repurchase, rounding off $16 billion of cash flow given to the shareholders in dividend and stock repurchase. Could they afford to do that? Same question I asked for Starbucks. Could they afford to pay $16 billion to the shareholders? Yes or no, and how do you know? Yeah.
I think they could because the free cash flow is great.
Their free cash flow is almost $19 billion. So here's the difference. They can afford that level of share repurchase. They can afford the dividends because they got $19 billion coming from operations, and they gave, rounding off, 16 of it to the shareholders, right? But that's sustainable, right? Starbucks had $3 billion worth of cash and gave $20 billion to the shareholders, or $30 billion to shareholders. That's not sustainable, okay? So completely different perspective on these stock repurchases and dividends. If I'm looking at Target, they can keep doing this. So that is a much more valuable stock buyback because that's coming from operations. They didn't get this from the banks. They get this from you, the customer. Okay, I like that. Right, that shows a better, more sustainable business over time, and I clearly see that in the CFI. Questions? Yes, sir.
How would you explain the money that they borrowed, like increasing the debt?
Well, when did they borrow most of it?
2000.
It was last year in 2021. So anything special happened in 2021? Free cash flow, $6.7 billion. CFI, $1.4 billion. Excess cash increased by $5 billion in that year. So almost all the increase in excess cash occurred in 2021. That happened to be the year they bought debt. They increased the debt. And their share repurchase was only $700 million. So there's about $2 billion to pay out. So if I had to put a few dots together, I would say rainy day fund. Like they bought the debt because interest rates were cheap. It wasn't a huge amount of debt and they really didn't need it. Okay. But this is going into COVID and we didn't know how bad COVID was going to be or how long it was going to be. So you can't blame a company for wanting to have more cash on hand to make it through the tough times. And I think that's the justification for why they probably borrowed that debt because otherwise they really didn't need it. They didn't have to raise their cash balance by $5 billion. They could have raised their cash by $3.5 billion and not borrowed any debt. So I think it was probably more rainy day fund than anything else. right? But they didn't need it to keep buying back the stock. Starbucks did. And so that's what I'm saying. Like, we can start telling narratives out of the CFI. If I'm a sell-side analyst, I can start asking questions of the company. I'll be like, hey, CFO, why'd you borrow the debt? It's clear you didn't need it. What are you doing with all that money? You know, or Starbucks. Hey, CFO at Starbucks, why are you paying all this stock buyback? Because you only got $3 billion of free cash flow. Why are you levering up the company so much? Okay? And there's probably answers to that question, but it prepares me to better engage with the company and to know what's going on. Okay? Other questions, comments about this? That's how you do your initial CFI. Here is Dollar General. Again, I'll give you a couple minutes to look at Dollar General's CFI, and then we will go through it. Again, focusing initially on the total column. All right, does anybody want to practice again on the 5-year CFI? All right, well, at least where would we start? What number do we start with? So what number on the free cash flow do we start with? This is the negative 1668.7, negative 1.7 billion of free cash flow, right? What happened to Dollar General? They generated 12.9 billion of gross cash flow for the income statement. They reinvested 14.6 billion of investment on the balance sheet. That's a reinvestment rate of 113%. They can't afford to pay out anything. Okay, they got negative free cash flow. Now, they spent very little on goodwill and intangibles, so their free cash flow before goodwill is about the same as the free cash flow after goodwill. Their CapEx depreciation ratio averaged 566% over the 5 years. All right, we kind of saw an allusion to this in the ROIC tree, but they're really spending on capital expenditures. They're really spending on store expansion. Okay? And even in 2021, they were spending 266% CapEx to depreciation, which means in 2022, they expected further growth. Okay. Now, negative 1.7 billion of free cash flow translated to negative 1.5 billion in CFI. So where did the 200 million come from in non-operating cash flow, 150 million? Well, 88 million came from decreasing their excess cash, and 65 million came from selling off some non-operating assets. Right? If you wanted to look at it, almost all that decrease in excess cash happened in 2021, $1 billion. All that non-operating asset sell-off, most of it happened in 2020. Okay. Now, what did they do with the negative 1.5 billion in CFI? Where'd the money come from? Well, they paid 476 million in interest, so now I need 2 billion. They borrowed $11 billion worth of new debt. Well, they need 1.5. Why did they borrow 11 billion in new debt? Well, because they paid out 1.7 billion in dividends and 7.8 billion in share repurchase. Well, that 8 and 2 is 10. How do you pay out 10 billion to shareholders? You borrow $11 billion worth of new debt. So interestingly, Dollar General, which is making a little bit more in the stores, we saw in the ROIC tree, they're really stepping the gas and opening up a bunch of stores. They're opening up stores faster than they can generate cash flow to do it, and they're buying back stock. Okay? A lot of it. So that's their story that we see with the CFI. Questions? Is everybody following this? Does everybody know how to do this? Because your next homework assignment, which is due a week from today, individually, is I'm going to give you 5 years worth of data for another company through 2022, so it'll be recent data, and you're going to have to explain the ROIC tree. You're going to have to explain their CFI, just like we did here in class. That's going to be homework 6. Minimum 500 words. I don't think you have any trouble writing 500 words here. Using numbers, going through and doing all the parts of the tree, all the parts of the CFI. That's next Monday. In addition to next Monday, your next group project presentation will be done. We'll do the 10-minute presentations by team. All teams will present next Monday. Okay, so 2 things we're doing next Monday. And I'm going to put up homework 7 today, which is going to be due 2 weeks from Monday. So you can start working on it this week, but here's homework 7. Homework 7, I'm not going to give you the ROIC tree. Homework 7, I'm not going to give you the CFI. I'm just going to give you an income statement and a balance sheet. You have to convert those statements, create the ROIC trees, create the CFI, and then analyze them. Okay? So that's homework 7. I said it's a little bit more ambitious of an assignment. You have 2 weeks to do it. And so just remember, I'm having surgery on Wednesday, so there'll be no lecture on Wednesday. Take advantage of the time to work on these assignments. Take advantage of the time to work with your team to get ready for your EIC presentation next Monday. Okay? Look forward to hearing those. If you have any questions, remember TAs have office hours the next Thursday, Friday of this week. Take advantage of that. Okay? And where is the sign-in sheet?
I think I handed it to you.
Okay. Yes. So if anybody didn't sign the sign-in sheet before you leave, please come up and sign it. Otherwise, I'll see you 1 week from today. Have a great week. Yes.
It says homework 6 is